Hello, everyone. Welcome to today's session, revealing tax hikes and its impact. We want to specifically focus on the tax law change. So before I start, I would just like to thank everyone for spending some time with us during this presentation. If at any time, if you have any questions or if you are looking for any clarification, please feel free to put a question on the chat, or you can also send me an email and I will try to go back to that and address it right after my presentation. And if time permits, or if time does not permit, I'll just reply you via email, but I'll make sure that I will answer your questions. I have a hard stop at 2 p.m., so I will just try to cover as much as I can. And trust me, today's session is jam-packed with so much information, and at any point if you feel like you missed on anything, please don't panic. We're going to share the replay of this webinar and you're not going to miss anything, and that way you can always go back and refer to what if you missed anything. So without further delay, let me just get started. So quick overview, I will just give a brief introduction and then we will go over all the changes that happened in 2021, where we are at today, and what's happening, what's next, the opportunities, and how to navigate through. So to give you a quick overview, we are industry-leading advisory firm founded by two sisters. We are one-stop shop solution for all tax and accounting related needs. We specialize on creating customized, innovative tax strategy to live fruitful life, to achieve ultimate financial freedom, to leave lasting legacy. And we are just not your average CPA firm. Our goal is to help our client create more time, more money, and more magic in their life. And with that being said, we are proud to say that we have been named as one of the top 100 professional in 2019. We were also named as best in 2020, and we were also the reader ranking winner for straight 2 years in the row for 2020 and 2021, thanks to our team and cooperation from all our clients. Intellectual property notice. The material in this presentation has been prepared by and is the property of QBID Tax Divisor CPAs. All contents, including the images and impressions, are protected under US intellectual property and trademark law. Any reproduction or dissemination of any element of this presentation without prior written consent from us is expressly prohibited. If I'm going too fast, please, you can put a message in the chat and I'll try to slow down, but I really want to cover as much as I can, and I just don't want to miss out on any of this important information. So for those who doesn't know me, my name is Taruna Kanani. I'm a CPA, Masters in Taxation, Certified Tax Coach, Certified Tax Planner, Certified Consular Accountant, President and Founder of QBID Tax Divisor CPAs. I have more than 12 years of tax industry experience. There are millions of accountants and CPAs in the USA. However, there are only 700 accountants who are certified as a certified tax coach, including me. And as a CTC, certified tax coach, I'm extensively trained in finding loopholes, business expense deductions, and credit. And thereby we are able to save thousands and millions for our clients in tax saving. I'm also Forbes Business Council member. So this is how I got started. As we all know, small businesses are the backbone of the strong, thriving economy. My dad was one of them. As a kid, I had witnessed firsthand the struggles and the challenges my dad faced as a business owner, and as a result, we all suffered as a family. And that's when I had decided that I want to become an accountant. However, soon I realized that the academic knowledge that I received during my education, college, the trainings, internship while working with the accounting firm, it only prepared me to provide the compliance or what you call the tax preparation service, which I think is not enough to serve and to pursue my goal and the way I wanted to help the small business owners. And that's when we made it a family mission to help small business owner. And we founded this KB Tax Divisor CPAs with my sister. So through this KB Tax Divisor CPAs, our goal is to help our small business owners with customized innovative tax strategy, help them build, grow, and protect their business with peace, certainty, and freedom that they really deserve. And to remind them that they became a business owner for more time and greater rewards. We want to create more time, more magic, and more money in their lives. So before I go into further discussion, I just want to put this disclaimer here that the majority of today's discussion will be on the proposals and the plans. And it has not yet signed into law yet, and that is exact reason, like some of the items presented in today's presentation might change, and we are closely monitoring each and every development. And once anything gets signed into law, we will hold another informative webinar and go over any information that will applicable in your situation from the tax point of view. So I really want to walk through what these proposed legislations are, where we came from the beginning of the year until where we are at today, and the progression of discussion on some of these proposals. There were lots of windy roads that legislations has gone on this year. However, at the time we are recording this webinar, none of what we will be discussed is actual law, as I said before, and all that has been provided are the plans and the proposals. So 2021 tax legislation proposals. Now, just to begin with, back in March, the big thing that was actually signed into law was this American Rescue Plan, a 1.9 trillion bill as a coronavirus rescue package. And it was designed to facilitate the United States recovery from this devastating economic and health effects of COVID-19 pandemic. It was designed specifically for United States taxpayers. Then just a few weeks later, we had this American Jobs Plan that was a 2.5 trillion bill, and it was called the fact sheet. It was a proposal that was released, and that's what the Biden been saying on the election trail that he was on the year before, and this was what was put on the president's website with all the different intricacies associated with that. The next one, literally a month after, the proposal on American Families Plan was released. It was 1.8 trillion, and again, it was a fact sheet and information about the American Families Plan, and all that mirrored very closely to what he had said in the campaign during November. It was a really big shock, and one of the big things that came out of this proposal was that potentially the higher capital gain tax that was going to be applicable retroactive as of the date he proposed, which is April 2021. And everybody felt a need that they need to go back and sell assets or whatever they were planning to make capital gain in April 2021. However, since then, nothing has been signed into law just yet. It's still in the air in terms of when that retroactive, if all, will be applicable and if it will be signed into law or not yet. So it's still in air. Then we actually had an agreement that was released later on in September 2021. But if we take a look, and it was going to start releasing the budget resolution outline, and that came out on July 28th. So that was the first time when they started talking about this 1.5 trillion instead, and have that initial part of launching the new legislation that President Biden was looking for. In August, you saw this new 1.2 trillion infrastructure package that did get introduced and did wind up passing the Senate. That was the first legislation that had been released after American Rescue Plan that was passed by the House on November 5th, and then later on signed into law by Biden on November 15th, just merely 2 days ago. The Senate also passed this 3.5 trillion budget resolution, and not the actual bill itself, but if they passed it, they will go forward with the resolution. I just want to be, okay. Now, then what House did, they did the same thing, making available to pass that 3.5 trillion bill using this simple majority using the budget reconciliation process. And it was passed on August 24th. So then what happened was the House came out with this memorandum outlining the 3.5 trillion plan that came in from the Ways and Means Committee, which was actually really in that discussion of how they're going to afford and finance the specific tax change that will take place to afford the bill like this. And that was released on September 15th. Then a few weeks later, they attempted to pass the 1.2 trillion in bipartisan infrastructure bill while negotiation continue on the larger 3.5 trillion social safety net legislation, and it actually did not take into the floor and they did not move forward with it. So then at the end of the month, it was really important to avoid the government shutdown happening on September 30th. So White House came in and signed into law the extending government funding and delivering emergency assistance till end of the December. Now that assistance was also provided some other funding that will be available next year and the year after. So they were able to successfully avoid the government shutdown, and that came on September 30th. And then you had this debt ceiling that was coming due on October 18th. And President Biden signs and says that US debt limit is going to be averted and we are going to raise it. And that happened on October 14th. So as I mentioned earlier, really only two things have been signed, the American Rescue Plan and the bipartisan infrastructure bill. So now let's see what was included within each of these. I'll just touch base briefly on this, and then I want to spend more time on the budget that was proposed by Ways and Means Committee back in September, because that will be a bit more relevant to what we are doing here. 1 second. So then we have this American Rescue Plan. The biggest thing that came out of this American Rescue Plan was the economic stimulus they were trying to push out via this plan that was signed into law on March 11, 2021. It was a 1.9 trillion bill. It also provided for small business credit, where each state was also allowed to provide any additional credits or disaster-related financing to small businesses. Then interestingly, it also extended the ERTC to Q3 and Q4 of 2021. So prior to this, ERTC was set to expire on June 2021. So they just extended for another 6 months. It also ended up extending paid leave credit program. No major tax law change at this point, as it was purely focused on economic stimulus from the COVID effects of 2020. Then we had American Jobs Plan. This was really a proposal. So American Jobs Plan also included the guidance on how to fund this infrastructure proposal with the tax increase. Again, this is not the law, it's just a proposal. But inside this American Jobs Plan, they wanted to increase the corporate tax rate to 28%. We heard about it during the campaign trail, but this was our first time seeing after President Biden came in office. And as you know, this will be a big jump from the current rate from 21% to 28%. So that what we saw, and what else we saw here was potential the discussing and discouraging offshore jobs, increasing the minimum tax on US multinational companies and increasing it to minimum to 21%. And it also provided that it will be calculated on country by country basis, and it will result in elimination of zero tax on the first 10% of interest. So currently, if company goes out to a different country, they don't necessarily have to pay tax on the first 10% of the interest that comes to them. So essentially, they just want to get rid of it. So in nutshell, most of this proposal was trying to repeal some of the previous tax law that come into play. It targets some of the tax breaks that currently US taxpayers were enjoying to raise the fund to finance some of these proposals and bills. They also wanted to prevent US corporations from inverting and or claiming the tax havens as the residents, and provides that a tax credit to bring jobs back on the shore. And I think it directly ties back to that bring jobs back to America initiative. It also provided to eliminate the FDII, which is essentially the foreign derived intangible income, and the tax incentive associated with that. And what they wanted to do is they wanted to throw this 15% minimum tax on the income for very, very large corporation. And again, here they do not define, I mean, we do not have any insights or clarification what will make this very large corporation. So that was little scary for major corporation out there to see a minimum tax on gross income and not on necessarily the profit. So right now the tax is based on the net profit, but according to this law, they want to tax the gross income regardless whether you make profit or loss. So that I found it's very interesting. Further, they also wanted to eliminate tax preference for fossil fuels. This has actually been a very big argument in the last few weeks as well. They were talking about clean energy and providing a different incentive for clean energy, and whether or not they are going to include that in the infrastructure bill or not. But the last piece, which everyone started to pay more attention to, was ramping up enforcement against corporations. So that's different too. So what they want to do is they want to give IRS more money, more resources, so that they can enforce this against certain corporation to make sure that they pay their fair share, which was the biggest sort of wordings that they wanted to throw out here. Now, after that, a month later, Biden came in and added this American Families Plan. And this is when we started seeing changes happening on the individual level and not just on the corporate level. So American Families Plan. Oh, 1 second. So this Americans Family Plan is a 1.8 trillion campaign bill, and it will include 4 years of free higher education. So that was pretty interesting. So it was just trying to help families in America. It also provided a direct support to the children and families. Wanted to extend certain tax cuts, including child tax credit or income tax credit, and also the child and dependent care tax credit as well. The American Families Plan also included the guidance into how they can afford this new proposal that ties in specifically with tax increase. So here they included and they provided for 39.6% as top tax rate for the individuals. This rate has been very consistent number that we have seen so far. Everybody keeps talking about this 39.6% as the top tax rate. They also wanted to tax household. They were making over $1 million to pay the same 39.6 rate on all their income, which I think was a big potential change. There's also a big negotiation, and a lot of people continue to talk about it. It's wavering what people are discussing in the last few weeks. They also wanted to close the carried interest loophole that stayed around, and it includes 3.8% Medicare tax on the earnings for those making over $400,000. So these proposals attracted quite a lot of attention, since the biggest question was whether or not the capital gain rate was going to be retroactive from April, And they mentioned that it was planning to be, but that did not actually happen, and it still remains as a puzzle as of today. So from April on, no additional proposals were released, but negotiations were still occurring behind the scene. From April until when they started to ramp up in August, there was a memo that came out, and it's very well known as the lit memo. And that was between Manchin and Schumer. And basically, again, this is a back of napkin kind of memo and does not necessarily mean anything. But I felt it was interesting to see what they wanted to discuss and begin the debate after October 1st. So they said after October 1st, they wanted to see corporate tax rate of 25%. Now remember, not 28%, but 25%, which is what I thought originally was going to be. And that's a proposed for corporate domestic minimum tax at 15%. They also wanted to have that 39.6% as the top tax rate and raise or increase the capital gain to 28% all in. Also has a provision to end the carried interest. So again, this was just a little memo that was later on. So few days later, and obviously between these two major Democrats to determine how they were going to pay for this infrastructure bill, for infrastructure bill of 1.2 trillion, they came out with this bipartisan infrastructure bill, which was also provided for 1.2 trillion provision. So you know that they did not include any major tax change within this fact sheet or this plan, but this is an actual bill that was passed and signed into law by Biden on November 15th. It was 2,700 pages long and provided for 500 billion in new spending. This bill specifically aims to revitalize the nation's road, bridges, waterways, public transit. So it was obviously straight on infrastructure. This measure provides 110 billion for roads, bridges, and major projects. Provides for like 39 billion for public transit, 66 billion for railway, and it has like all these details, and also provides some of the leftover remaining fund to fund for safety ports, buses, etc. So it doesn't say anything about the tax change, but it does show some of the financing perspective. And it says that here is how we're going to pay for this bill. And so there were certain components that they wanted to include here. And some of them are like they wanted to extend expiring customs user fees. They also wanted to extend mandatory sequester. And they also wanted to have public-private partnerships, private activity bonds, direct pay bonds, then assets recycling for infrastructure investment. So they threw out all these different ways to potentially fund it. But as I said, none of it actually tied into US tax specific changes that we were going to see. Because obviously COVID continued, White House came out with its updates for addressing COVID that included additional aid for small business. And this was right at the time when Delta virus was coming out, and everyone was like, oh great, so this is another wave. And so they came out with this COVID plan updates. So it was an executive order that was released on September 9th, and it removed that 500,000 cap on EIDL program. So if you know that whole time that EIDL loan has been in existence, even before COVID, it has always been capped at $2 million. And that's the most anyone can get it. However, when COVID hit, the SBA changed the rule, did not tell anyone, and they changed the rules to limit everyone at $150,000. And that is as much as you can get for EIDL program. Again, that was initially. Then they came out saying, actually, we made a mistake and now we should bring it back up. So at the beginning of this year, 2021, they raised it to $500,000. Now, as of September, with these COVID updates, they went back to the normal rate, which is at $2 million for a specific industry type. So those of you who are still facing any financial distress or burden as a direct result of COVID, you can certainly go ahead and request increase in EIDL loan for up to $2 million. So they streamlined the process to make it a little bit easier by thinking of the small business owners. But as you know, there is so many complexities associated with EIDL loan, and therefore I may suggest you might want to consult professional. I'm sorry, I was not going too fast. And it also streamlined PPP forgiveness process where SBA will send loan recipients a pre-completed forgiveness application for review signature. It also provided acceleration of partnering with community navigator programs that can assist small business owners with accessing federal relief funds. So a few days later, what happened was this Ways and Means Committee released its proposed budget on how to finance 3.5 trillion infrastructure bill. And this is what was really crazy because it detailed the proposed tax law change. It definitely created some polarization within Democratic Party, and a lot of people and are still negotiating what some of these points should look like and what it means. So it's still under negotiation, and it's called the Reconciliation Budget Bill. It was released on September 12th. As of now, it hasn't gotten to vote by the House yet. It just came out from the Ways and Means Committee. So it's a portion of the House, but it was designed to enact the President Biden's Build Back Better initiative. And then, you know, obviously, it also plays in line with what American families and American jobs plan look like. And under this bill, what we ended up seeing was 26.5% on income over 5 million for the corporate. So top corporate tax rate went down from that initial 28% to 26.5%. And I think that was really interesting because what they're thinking that if they were increasing too high, probably it might hurt economy. So they had this income of up to $400,000 that would be subject to lower 18% rate, with a current 21% rate remained unchanged for income between $400,000 to $5 million. So interesting thing to notice here is that 400,000 mark is being consistent, and it's been like, that's what like everybody's talking about. They have this personal service corporation, and they will not be eligible for any graduated rates. All income will be showed into 26.5%, and then benefits of graduated corporate will be phased out by additional 3% tax on corporate income above $10 million, and up to a maximum additional tax of $287,000. So that was a corporate and business provision tax increase that we saw from here. It also provided some additional amendments and changes, for example, amending section 163J to apply interest limitation at the partner or as corporation shareholder level rather than entity level, because it passed through to the owners when they prepare the tax. They also wanted to limit carryover of business interest deduction that would be disallowed under IRS Code section 163J to 5 years on a first in, first out base. And it may effectively increase the rates on both GILTI and FDII income through reduced deduction and exemption. They also want to require a partner whose partnership interest becomes or considers as worthless to treat that loss as a capital loss. So just a couple of little, nuances here and there, some changes here and there. So they also wanted to target non-resident aliens. So what they provided that non-resident aliens to have 30% withholding tax for their interest income when they receive it from the company for which they own directly 10% interest. And so that was more on the immigration side. They also want to require a holding period on the carried interest for 3 years to 5 years. Bar taxpayers with $400,000 or more AGI from qualifying from 75% or 100% exclusion for gains on qualified small business stock. One thing to notice here is that they wanted to make it effective as of September 30th, and which is the day that they launched this reconciliation bill. So the question is that really going to stay as it is? I don't know, but outside of just paying the capital gain to become applicable retroactive, they wanted to throw this wording out here just on this particular provision and not anything else. So they also wanted to expand these constructive sell rules and the wash sell rules to digital assets and currencies. And that will be interesting. They also want to disallow a deduction from conservation easement perspective. If you know, it came out on December 20, 2016, and I think it was a memo or letter, something like that, but I don't remember. So what they want to do is they want to make this retroactive to applicable 2016 and disallow to anybody that had gone through this syndicated conservation easement past that date. I found this particular proposed change very interesting because, this happened years ago, back in 2016, but now they want to make this retroactive and want to go after whoever utilized since 2016. They also want to accelerate a termination of employer credit for paid family and medical leave to 2023 rather than 2025. And they also want to allow certain S corporation to reorganize as partnership without triggering any tax if it's done in 2022 or 2023, which I think could be a potential strategy that you might want to consider in case this gets signed into law. So all that we saw so far was set on the corporate side. Now we want to move over to individual side. So here they included this 39.6%. Everyone has seen that. They also gave the range of what that looks like for joint filers and for head of household. They also provide for 25% capital gain rate for taxpayer with income that falls into this new 39.6% income tax bracket, which I thought the capital gain were going to be the top tax rate. But in this case, it was actually said, no, we are not going to do that. We are going to just increase the capital gain tax rate to 25%. And on top of that, they wanted to make this retroactive as of September 13th. So this was the first time that we saw. We thought originally that it was going to happen in April. Now they are saying September 13th, the day they launched this reconciliation bill. So I don't know if it's going to be true. And I wonder if people are continuing to sell, and we are gonna see what happens if once this becomes law. So next thing, they also wanted to apply this NIIT, net investment income tax, to ordinary trade or business income with taxable incomes over $400,000 with an exception for wages subject to FICA tax. So I think that will be a little bit of pain. They also wanted to cap QBI, qualified business income deduction for individual earning $400,000 or $500,000 for joint filers. One other thing, they added a new provision is 3% surtax on incomes over 5 million. This is very interesting, and this is something they haven't done anything like this previously, especially as far as the retirement is concerned. So they also want to go after retirement. There were some leaked memo or leaked findings that came out with how certain billionaires were making, utilizing some of the tax strategy. So they decided to change that by prohibiting any additional contributions to IRAs if the balance exceeds 10 million and the taxable income is over $400,000. Not only that, on top of that, they also require that you take mandatory distribution from your IRA if your account balance exceeds $10 million, which I think is pretty insane. They haven't done anything like that previously. they don't want to stop here and they want to go further on retirement side. So what they want to do is, if your retirement balance exceeds $20 million, they want you to distribute 100% of any excess with Roth IRA, Roth account in 401k, and any other defined contribution plan. They also want to prohibit Roth conversions of after-tax contribution to be qualified plans beginning 2022. So essentially, they are targeting to eliminate really the backdoor roads for anybody who's earning over $400,000. And they also want to prohibit or restrict IRA from investing into an entity where the account holder owns more than 10%. So again, they went after retirement, very different way than what we have seen previously. So this was a 3.5 trillion proposal that had not gone to the vote and is still pending agreement from the House members. So at this point, there are two different types of bills that are waiting to be voted. Actually, one got voted on November 15, but some legislators are trying to make this as a package deal, but I don't really see that it's happening. And here is a recap of how they break down. So here we have infrastructure bill that wind up passing the Senate on August 10th, passed by House on November 5th, and then signed into law by White House on November 15th. That was really the only one that ended up passing. And on other side, you have this reconciliation bill, which is still waiting on the House until it comes to the Senate. And then on the House side, it was introduced as a bill to the House on September 12th. So when you guys see these words, infrastructure, reconciliation, and budget, it's very confusing. But I finally got it to try to nail down to show you here that you have this infrastructure bill and then you have this reconciliation bill. The latter is something that we are waiting on. We are looking forward to it because we are trying to determine what's going to happen with them. And of course, since it all includes the potential tax changes, that's something you want to keep an eye on. So what's potentially coming? Now, you must be wondering, right? Like, what do you do? Or you might be asking questions like, how will you handle this? Is it really going to happen? Or where is the increase? And all sort of questions. So, well, you can certainly benefit from some of the tax strategies that you can move forward today, regardless of some of these changes. But what you are going to notice is that on the capital tax or capital gain rate is you are going to see increase. You are going to see increase anywhere from 25% up to 39.6% increase. So more likely than not, that is what we are going to see on the capital gain tax rate side. We may or may not see that retroactive. Now that Ways and Means Committee came out with retroactive as of September 15th. But I could be wrong. They could negotiate to make it effective as of December this year, or they could go back to April. Hopefully not. But we will see as time comes. But regardless, you will definitely see an increase anywhere between 25 to 39.6% tax on this capital gain. Now, on the corporate tax rate side, again, I thought it was going to be straight 28%, but there was negotiation for 25%. And there has been recent negotiations saying, actually, we don't want to increase it as it might affect and it might cause too much damage. So we just want to keep it as it is. But in general, here is what I'm predicting. It might change and it can be anywhere between 25 to 28% as far as the corporate tax rate is concerned. On individual side, that top individual tax rate, we have only seen 39.6%. And as you know that it has been a consistent statement from everybody from day one. So it looks like everyone is going to wind up seeing that increase top in your tax rate to 39.6%. Now, the question is, where that line is going to be. Is it going to be at $400,000 or is it going to be at $500,000 or what is that going to look like? We don't know yet at this point. Now, at this point, however, this 39.6% seems to be at the top of everybody's mind, and I believe will most likely be included in these tax rate changes. They also have this they also have been like pretty consistent that they want to remove that stepped up basis. So that was a big kind of a discussion back a few months ago. They wanted to remove that, but they say for gains over 1 million or so, that was something that we think that is going to be pretty consistent, and they will probably keep it as they launch this new bill. On the carried interest side, basically what we are saying, either they're going to either they're going to end it completely. I mean, we saw that with that leaked memo where they proposed to end it completely, or in other scenario, they could increase the required holding period on the carried interest from 3 years to 5 years. In order for amounts received on such interest to receive the long-term capital gain, they want to increase and change that minimum holding period requirement from 3 to 5 years. So we will see what happens with that, but I'm very curious to see what winds up coming into play as a final change, because it's all moving between different proposals and this committee resolution bill. Now, they also want to apply NIIT, which is a net investment income tax, to ordinary trade or business income. That has been consistent as well that we are seeing so far. So taxable income over $400,000 with the exception of wages subject to FICA tax. So anybody that who winds up making over $400,000 may see that their NIIT tax will increase, and that will be in addition to that top individual tax rate. So I'm assuming it's going to increase your income tax substantially. The next, they also want to go after this capitalizing qualified business income deduction for anyone who's making $400,000 as an individual, or $500,000 for joint filers. Now here, usually like they just double this cap or break-even point, but now they just allowing $400,000 for individuals, but only $500,000 for joint filers. So I feel like that's something going to be very interesting, and this is very consistent that we've been hearing from day one. So I feel like it is going to be very unique, very unique. Now, corporate minimum tax rate of 15%, it will potentially offer instead of raising corporate income tax rates to 28%. So it will be one or the other. Now, sorry. I found this thing very interesting. One other thing that I wanted to mention is, I could probably say that there was a newspaper article or something that was released, and it was based on everybody's tax return, especially the major companies' tax returns. And it started talking about that, well, you could potentially tax at the unrealized gains and not just realized gain, which I found pretty interesting. They also started to do this new net worth tax rate, saying that let's tax on your net worth, not on your actual income. So at that point, it was just a random newsletter article or whatnot. But then what happened was White House came out and they posted an article on whitehouse.gov website. For those who are interested in reading this article, I do have a link here, and if you would like, I can definitely share as a follow-up email. And I believe it's still live on their website as of yesterday. So this article was talking about that their plans, like how they were thinking that this will make sense. And They were also putting together what you call an argument for why you could potentially measure on your wealth and your growth in the net worth rather than just your realized income. And surprisingly, they even put together a formula on how they were going to do this. So we link the White House articles here, as I said, and if you want, I can definitely share with you. But I feel like this is a really, really crazy concept, you know, and whether, I mean, they go after just the top tier of wealth, or whether it's a true wealth tax, or whether they consider anybody over $400,000 at that rate, or you might ask, like, how are they going to tax at the growth or just the growth of the net worth? How are they going to calculate the net worth? All these different components are going to come into play here. But this is something to keep in the back of your mind, that this is an idea that has been circulated and has been put forth from the White House directly. Potentially something we may see either in the next few months, next year, or it may never happen, you know, because it's just an idea that is that out there. So you could see new wealth tax on two things: real estate holding. And when it comes to this wealth tax, you may see that real estate holdings which already have an assessed value by a state property tax or most jurisdiction, or you could potentially see it on publicly traded stock which can be valued at the fair market value. So next step, before I go to the next step, again, I just want to put a weight on this, that as I said before, it's just a proposal. Nothing is signed into law just yet. At this time, we are closely monitoring all the negotiations and the further development. And as I said before, once it gets signed into the law, we will host an informational webinar to go over the key component that might affect you from the tax perspective, and related guidance and tips like how you can benefit from these changes. So if you would like to know exactly like how much you are overpaying in tax, or if there's any specific strategies that could apply to your situation based on your current and proposed law, or simply if you just want to track the tax legislative change that might happen in the future, you can use this link. And again, I'll provide this link as our follow-up email to set up your complimentary tax and legislative assessment. And as I mean, here I would just like to thank everybody for joining us today. We covered a lot of information. I really hope that it was informative. At this time, if you have any questions, I will certainly like to answer. I still have 10 minutes. So 1 second. I'm just see if there is any questions here. Okay, so there is a question, and as I said, yes, unfortunately, I will not be able to share the slides, but I will be happy to share the recording of this webinar, and as a follow-up email, and that email will come with a link to these articles as well as link to the complementary strategy if you will like. And okay, I see that. To answer, so someone is asking anonymously how to plan for capital gain tax increase. As I said before, like everything that I showed here was just the proposals, discussions, and going back and forth between the House, right? So nothing has been signed into law yet, and we are looking at a capital gain tax rate increase anywhere from 25% to 39.6%. And at this point, we don't even know whether it will be retroactive as of April, September, or December. So it's all in the air. But if you are interested in mitigating your capital gain tax, there are a couple of ways, regardless of what is the current law versus proposed law. You can still benefit either eliminating completely or saving about 99% on the capital gain tax rate. And I will suggest scheduling complementary analysis so that we can walk over and show you what your options are. With that being said, thank you so much. And again, I'm grateful that you were able to spend your precious time with us, joining me with this live webinar. Thank you so much.